Hello, everybody. My name is Michelle St. Pierre, and this is Valhalla Mortgages. I am a mortgage agent level 2 servicing all of Ontario. This video is all about how to turn your principal residence into a tax deductible mortgage. By doing so, you actually end up paying down your mortgage significantly faster and creating more wealth for yourself and hedging against things like inflation and also preparing for your retirement in the long run. Now, I'm going to go through the process with you how to do it. If you do like this content and want more of it, please like, comment, and subscribe. If you want to hit the bell notification, I'd really appreciate that. It does help me out a lot. I do post a lot of videos about mortgages, and I'm going to continue to do so as time goes on. So you'll be receiving a lot more information about mortgages and how to provide better wealth for yourself and your family as time goes on. So let's get into the rental cash damming and how it works. So why do we want to rental cash dam? Well, one of the things we have to remember is tax efficiency is something very important. There's a lot of opportunities to reduce our personal taxes, and we can use those additional tax returns that we get from reducing our taxes to pay down debt or invest in other things. One thing that people forget about their mortgage is when you make a mortgage payment from your own income, you are already paying with after-tax dollars because you're being taxed at source. Your employer is taxing you through your deductions and whatnot. So you are being taxed at source already. So you're already making mortgage payments with after-tax dollars. So the rental cash damming strategy is a way of getting some of that tax back so we can use it to pay down our mortgage faster. So first step, if you don't already have one, to do rental cash damming properly, you need to have a rental property. So we want to acquire an income generating asset that'll help us build wealth in the long run. Number two, we need to make sure that the structure of the mortgage on our principal residence is set up properly. So we need to have a mortgage and secured line of credit component. So we need to have what we call a readvanceable mortgage product. As you pay down your mortgage, the credit limit of your secured line goes up with it. So these are readvanceable products. There are many on the market. We need to make sure that you've set it up that way. The reason why is we're going to be using this product as a way to create a tax deductible loan on your home. And of course, we want to reduce taxes so we can keep more money for ourselves and reinvest proceeds in the future to get financially ahead. So we can use those tax returns to do many things. One of the main things that's great is we can use this strategy to make ourselves mortgage free, or should I say, we can have good debt versus bad debt a lot faster, make ourselves much better off. So how does a debt conversion process work? Keep in mind, the goal here is we want to convert our bad debt, which is not tax deductible, into good debt, which is tax deductible. A bad debt is the mortgage on your principal residence. So we want to structure a principal residence in a way, as I mentioned previously, where you have a mortgage component and a secured line of credit that grows, the limit grows as your mortgage is paid down. You want to be able to reborrow the money that you're paying down off of your mortgage. Number two, we want to pay down the bad debt, as I've mentioned. So next step, we want to pool together our rental income and our personal income to pay down the mortgage on our principal residence. I'll go over this a little bit more in the video, later on in the video. And then number three, by doing this, we now have the available secured line of credit on our home, which we're going to use this to pay our rental expenses, thus creating an investment loan to ourselves, which we can use for tax write-offs in the future. So now, as we're paying down our mortgage with rental expenses, with the rental income, and your own income, you now have that line of credit, which you're going to be using to cover your rental expenses, thus creating that investment loan, which will create tax returns for yourself, some tax deductible debt, which you can then use those tax returns to pay down your mortgage faster, or for anything else you want to do it with investments and whatnot. Ideally, we do want to focus on getting rid of that mortgage though. So let's go over the process of how to do the rental cash damming strategy properly. Number one, you have your income coming in from your employment. You use that income to make your normal mortgage payments. So no change there. We're still making mortgage payments from our income. No change there. This is where the change starts. So the tenant, of course, at the beginning of the month pays you your rent from your rental property. Okay? So now, instead of using that rent, this is where the change is. Instead of using that rent to pay down the debt of your rental property, so for the expenses of your rental property, the mortgage, if there's a condo, the condo fee, property taxes, insurance, all that stuff that you usually used for your rent, we are not going to use the tenant's rent payments that they're paying you for that anymore. You're going to take that rental income that you're getting in, and you're going to use that rental income and you're going to apply it as a prepayment to your mortgage every month. So that rent money is going to come into an account and it's going to go directly to pay down your mortgage too. So don't forget, you have your income paying down your mortgage, and now we have the rent coming in to also pay down your mortgage on your principal residence, your bad debt that is not tax deductible. What happens now is, because we're paying down your mortgage and you have set up that readvanceable line of credit, that line of credit limit is going to increase. So you can use the limits and the credit limit that you've just acquired on that secured line of credit to pay your rental expenses. So that is how you're going to pay your mortgage on your rental, your taxes, if it's a condo, the condo fee, and any other expenses are going to be used. That line of credit that is secured to your home is now going to be used for that. So now we're converting that secured line of credit into a tax deductible line of credit, because an investment loan now, we're using those funds to support an investment, your rental property. Now what's great is, as I mentioned, now we get tax returns off of that line of credit, and we can use those tax returns and we can apply more prepayments to your mortgage with those tax returns, thus reducing your bad debt even faster, making yourself mortgage free much quicker, and growing your wealth a lot faster than just having it the traditional way. So that is how you do rental cash damming. Really great program, and it helps you get wealthier a lot faster. So if you made it this far in the video, thank you so much. If you do like this content, please like, comment, and subscribe. Hit the bell notification. I will have videos coming out every week about mortgages and mortgage products. My next one's going to be on reverse mortgages. If you want to book a meeting with me, once again, my name is Michel St. Pierre, and I'm a mortgage agent level 2 servicing Ontario. My Calendly link is going to be in the description below. You can also follow my other social media links as well that are in my bio. Thank you again, and have a great day.